All right, everybody. So let's go over the ES and crude. See what the hell is going on. So first and foremost, this thing I've been talking about it. This is concerning for shorts. That as the market made lower lows, the breadth indicators on the NICE and the other one, the Nasdaq, it made higher lows. And has a background biggest buying in the last 18 waves. So I want to see one more pullback here, hold. If there's one more pullback and the number is quite low, say relative to 17, like you see 17 here, if it pulls back and the number is low relative to 17, this thing, in my opinion, is going to be on a springboard to go up. Same here. If this number is 18, so at the pullback, if the number is low, it's going to be on a springboard to rocket up. All right, that's what the market breadth is saying. Otherwise, if it breaks the low, then obviously the market will confirm, the breadth will confirm the market, and the market will confirm the market breadth. So then this down move is legit. But until I see the breadth indicators break, there's something wrong with this move. So both need to get in sync for the market move and its components to confirm one another, right? Because the market is a function of its components. You cannot have its components going up and buying and not going down while the market is going down when one is the result of the other. You see what I'm saying? Anyway, so we'll take a look at where the accumulation and distribution was. I'm going to focus on this more, especially for Wyckoff style traders, because this is like the heart of the Wyckoff, what he's trying to do with all the climaxes and all of that, to really just identify accumulation and distribution so that you know where to buy and sell, because you're just trying to buy and sell where strong hands are buying and selling. And when they pull back to those areas, if they're still there, it's going to go back up, from accumulation areas and go back down from distribution areas. If they're still there on the pullback, you just join in. It's not rocket science. It's just what it means to follow the composite man is to follow his accumulation and distribution and trade alongside those areas, because that's where the support and resistance really is. It's not that, the extreme high or the extreme low. Those areas are extreme highs and lows, not necessarily areas to buy and sell because they don't get tagged. Especially on a pullback, you don't have 100% retracement. Majority of the times you'll have between 50 to like 78%, retracement all the way to the low bar or the high bar, but not 100%. So by definition of a pullback, it's not a pullback all the way down to the low. It is a percentage of the rally. Anyway, so where let's take a look at the E-mini short term, today's action. What happened was this was the latest swing low. All right, this was the latest swing low. So you know that in here there is distribution in order for the markdown, which is the bear rally, to occur. Now, when the market went back into this area, it offered a very small move, but what's more important is that the bearish move was absorbed. All right, so we know that in this area here, right, you have the redistribution. So we know that here you have redistribution, right? Because you understand that pullbacks, when they go, that ABC corrective pattern, all that shit is really just reaccumulation and redistribution, all right? So the market pulls back, you have that accumulation or distribution right here. Redistribution right here, right? Then it goes down. As it goes down, the price goes back up into that area of redistribution. where you have an edge, meaning the strong hands are there and they push the market down. So chances are when it pulls back, they'll get active and it'll continue to go down, right? But instead, it goes through the accumulation, the distribution, and instead reaccumulates right here. So here's the minor distribution, minor markdown, comes back to this area, and you see the sideways movement here, tagging this area, which is distribution or redistribution, resistance basically, and it slices above into that area. So you think that, it's going to go down because it's up thrusting, all that, blah, blah, blah. But what they're doing is they're absorbing. This here is absorption. What are they absorbing? They're absorbing the overhead supply right here. And after they absorb the supply, they bust through with this bar. This bar here is the breakout right there. Okay? So this is your minor distribution that in generally, if it was downtrending, it would tag it and continue down. And they're defending their sell positions. But as it came here, buyers spiked into that area. Sellers are unable to press. Buyers absorbed it and broke out with this bar to take out the high. So what does this mean in terms of trading? In terms of trading, we know this area and some here as well. The sideways movement always, it's not just sideways movement. It's usually some type of buying activity within a range. Why? Because they're trying to buy a price. If they're trying to buy an average price, they cannot have too much volatility. If you have volatility, you're not going to get a good average price. If you have like all the way up and all the way down, you're not going to get a good average price. In order to get an average price, you have to control volatility. And when you control volatility, it creates a range. And when that creates a range, you're getting the prices that you want. All right? Meaning if you have $100, then the volatility should be like $2, 102 to down to 98, and you can do that. But you can't have like 110 and 90. Right? There's too much of a range to get it's difficult to get an average price and move prices up and down and swing up and down like that. So you need a tight range. So that tight range is right here. This is the absorption, also reaccumulation, and that's the breakout. When you see expansion of the bar, it goes up. So now what you want to do is wait for price to come back into this area, see if those guys that absorbed this supply, they absorbed it, right? To see if they're still going to buy. If they're going to buy, it's going to, in the lower time frames, it's going to spike up. And that'll offer the trade opportunity. So that we just want to see prior areas of buying in the break and see if they're still there. And if they're there, you just buy it. That's it. All right. So that's a quick little lesson. Have a good day. Bye.